let's start with what the asset prices, how they are moving, and which indicators we are following to evaluate the asset price model and fixed income securities. By the way, what we mean by the fixed income securities and those type of things. Let me start with the house price cycle and auction clearance rate and house prices here. On the left-hand side, you are seeing a graph which is covering the weekly data, and it is showing the house price cycle. So the house price cycle is, especially as you see for the months here on the left-hand side, especially in the crisis period, they are really dropping on the blue line. And as you see in the orange line, it is just reflecting the 2022, and we are around here. And house prices, because of the interest rate decision around the world, started by the Federal Open Market Committee and European Central Bank. You know, first of all, you should understand how the house price correlated with the decision makers' interest rate decision. First of all, think this: if you want to accelerate and increase the house buying in your country, you should decrease your interest rate. Why? Normally, in a country, let's say we have trying to get a house that's cost $1 million. Okay, the total cost of the house is $1 million. All around the world, just the 1 or 2% of people give $1 million cash and take the houses. Above the 90% of people enter the mortgage loan, took the loan from the banks or financial institutions, give a deposit, let's say $250,000 they have at hand, and they need $750,000. So this $750,000 are supplied by the financial institution or the banks. Okay, by the way, keep this notation also in mind, that how much you can get from the banks as a loan to get a house can be determined by the regulation agency, like central bank or like banking regulation agency. For instance, if you don't want to increase the house prices in your country, you are decreasing the loan value ratio, loan to value ratio. We are saying this: the cost of house is $1 million. And if the authority in your country, banks, saying you that the most you can get as the house of loan is 3/4, meaning that you can get at most 750,000 loan from the market, and you should be at hand as a cash 250. By changing this loan to value ratio, the agencies and regulation authority can determine the house prices and their cycles. For instance, if they say that you can only get 50% as a loan, this means that for $1 million house, you should be at hand as a cash $500,000. At most, you can get $500,000, the rest as the loan. This is the loan value ratio. For that reason, because of the interest rate cycle, if you want to make a loan from the banks, the loan you applied can be correlated with the interest rate. Why? If I say to you, the mortgage loan rate now is 80%. Can anybody use the loan from mortgage? No, because I'm saying if you are getting $1 million, you are paying $1,800,000 in return in 1 year. 80%. It is huge. But if I say it is just 1%, everybody goes to take a loan because its cost is too low, right? So because of the interest rate hike, interest rate increase, nobody want to use those loans. So if you don't use the loan of mortgage, nobody buy a new houses. So the house price start to decrease. Okay, the left-hand side on the graph is trying to show and demonstrate this phenomena. Okay, and the right-hand side showing the auction clearance rate. This is mean you can think as how the auction made on the houses, and on the right hand side as the house prices. So the house prices, as you see, increased normally during the COVID crisis approximately 20%, but because of the increase in the interest rate, the house price during the 2022 approximately decreased 10%. Okay, it's shrinking. And the next slide, you can generally hear from the Bloomberg or CNBC or those type of financial authority regulation, those type of things. Let's say non-farm payroll, or let's say building permits declared today. What does it mean, building permits? If the government permits less houses to build, what does this mean? There will be less housing in the market, and this will increase the house price, right? But if the permit increase in the market, who the government can let the household or house build up, the infrastructure build up, people to build up and to supply more houses to the market, this means that house price decrease. So this house starts also correlated with the house prices. Let's say here, as you see, between 2010 and 2020, the house price, house starts, it is million units, approximately 2 million in each month. It is starting huge. But as you see, if the house start is decreasing, we are going into recession. Why? If you are in recession, nobody will buy a new house. So no need to build a new house. No need to start a new house, or no need to give a new supply of house in the market. And the right-hand side, you should take a look at this as well. As you see, housing affordability index. What does it mean? Housing affordability index mean you can get a new house with your cash or with your loan. And as you see, after the 2008 crisis, with the cheaper cost of funding, because interest rate decreases, lots of people afford more houses. But after the interest rate hike, nobody trying to get a new house because its cost is really, really high. This is the asset price. So just think this. This is a question to argue, because if you keep this type of question in your mind, you can easily find an answer what the asset price and what the asset price bubbles. If I give zero cost money to everybody here, zero cost dollars, you are borrowing from the banks or from your friend, you are borrowing $1 million, and your friend or banks don't request any money in return as interest rate. So you are getting $1 million, and 2 years later, you are paying $1 million. If this is a cheap money, you can borrow infinitely because there is no cost to borrow. So with that excess liquidity at your hand, you can buy stocks, equities, houses, cars. You can buy everything. Why? Because there is no cost to borrow, right? You are borrowing the money, but in return, you are not paying any interest rate. So if the interest rate is decreasing, everybody get lots of loan from the market, from their friend, from their banks, from their government, from their institution. And with that money, they will create new demand to houses, stocks, indexes, equities, cars, everything. So their prices start to increase, right? If the interest rate decreases, everybody create demand for those type of assets, car, house, stocks, indexes, commodities, everything. Because the interest rate is decreasing and cost is lower to borrow. So if the interest rate decrease, this will result an asset price bubble in the market. If you buy a house 1 year ago with $1 million, its new prices will be $2 million today, because everybody created demand, and if the demand increase, price of houses will be increased as well. This is the house side of the asset price. And as you see in asset price, we have equities as well, right? Stocks, companies, Apple, Tesla, Amazon, everything, right? And one of the best well-known index is S&P 500 performance around last rate hike. Okay, look at these places. Okay, and what these graphs and lines showing to you, what this graph represents. As you see in the green line, 2018, it is the green line. After the interest rates start to decrease, everybody get the stocks and stock price and index going up. But when we start to interest rate hike process, this will create a new demand for the fixed income securities and the risky assets. First of all, we are starting a new session, and the name of the session is asset price and fixed income. So what we trying to say while we saying fixed income securities? For instance, let's say Dr. Walchin has a $1 million at his hand, okay, and he want to get a Amazon equity from the S&P, okay, let's say from the Nasdaq or Dow Jones, he gets a Ferguson index. After 1 year, not just Dr. Walchin, nobody else in the world know what will happen to Dr. Walchin $1 million if he puts his money to the Tesla or Amazon, because the price can go up for the stock or can be go down. There is ambiguity. There is a risk. Okay, there is a risk. These are risky assets. Indexes, options, volatilities, all these are risky assets. So you can put a $1 million, 10 years later, you can get $5 million, but you can turn back with $100,000 as well. Okay, this is the risk. But if you put your money in fixed income securities, you know what will you get at the end. So the fixed income securities are treasury bills and government bonds. Okay, fixed income securities. This means the American government saying you that, let me share my screen. I will help you to show you my Bloomberg screen. Okay. Do you see my Bloomberg? Okay. Let's say 10-year treasury yield for the United States. Here you will see US 10-year generic government bond yields. Okay, and let's see its graph. Let's make it max. And approximately 60 years government treasury yields. You see here 10-year government bond on the top. It is 3.75%, right? The green one. 3.75% for the 10-year treasury. What does this mean? This means that the Dr. Walchin at the end, if he puts his $1 million today, at the end of maturity, he will get 3.75% with absolute value. Okay, not less, not more, but it will come. But if you put your money in Amazon, your money can be melt, even evaporate. Okay, you can never be seen your money there as well, because it is risky. His price can be go down from $200 to $1, right? Like the cryptocurrency. They are risky asset. But if you are in fixed income, let's look at the fixed income screen in my Bloomberg, and you can see those fixed income credit monitor. Okay, here we have our fixed income credit monitor. Look at the screen. It's coming. As you see, these are the market indices for the fixed income securities. But let me show you. Wait. As you see here on the left hand side, you can see those fixed income. Let me show you here as well. Here, world bond market. Okay. As you see here, we have 10-year United States, Canada, Brazil, Argentina, Mexico, or emerging market economies, or we have Asia Pacific, and their 3-year, 10-year, even we can change our the maturity date. And for instance, when we look at the 2 years return for the United States, it is approximately 4.71%. Okay, so if you put a $1 million at the 2 years end, you will get this money with this percentage. Okay, so these are fixed income. There is no risk here. You will get what you want. But in risky asset like equity index, stock exchange, those type of places are risky asset. When you put your money, you can get zero profit at the year end, okay, at the maturity date. So I should clarify this point. Fixed income securities are riskless asset, okay, like treasury bills and government bonds. And secondly, as you see here, MSCI World Earning Growth and Price Return, okay, and MSCI World Index. What does it mean? MSCI World Index, let's look at it here, again from my Bloomberg. Let's look at MSCI. Okay, MSCI World Index. Look at this. Okay, here. And let's look at this one. Here, the MSCI return. Okay, this is the price and this is the return. So if we make a total return analysis for this MSCI return, as you see, if you put your money 2 years ago to MSCI return, this will get, if you put $1 million, you will lose $200,000 in this index. Okay, if you put your money. But if you put your money in here, do you see what's changing? If you put $1 million, you will get $500,000 after 5 years, 7 years. You get the difference? So the time span changes, your return changes. But because this is risky, you can lose and you can win. Okay? But in fixed income, there is no loss. Okay? It is fixed payment to you. Let's return our slides. As you see, this is price of oil. Ladies and gentlemen, always keep in mind, if the price of oil started to drop in the international market, you can just think that there is a problem. Okay, there is a problem in financial market. If risk appetite increase, people want to take risk, they will get the positive position call option on the price of oil. But if there is a problem, if there is a risk, if there is a recession, if there is a financial turmoil in the market, the price of oil start to decrease. Okay, 1 year ago, 2 years ago, it is $140 per barrel, but right now it is 70 because everybody's speaking about recession in the world, right? So it is prices decreasing. As you see here, natural gas prices. What happened here? Why it is hiked from $50 to the $300? Because of the Russian and Ukraine war, right? It is approximately increased 5 times higher because of the Russia-Ukraine war. Because Russia is one of the best producer of the natural gas, and because of the supply decrease in Russia, price is going up. Okay. Now, what we speak about government bonds and government treasury yields. This is, as I said, fixed income and asset prices. And we are speaking about what is happening here. So let's try to understand what does graphs showing us. If you understand these government yields, you will understand fixed income securities. Okay, asset prices and fixed income securities. On the left-hand side, these are 10-year treasury bond. Okay, and these are yields. As you see, Australia, and which one is that? Let me. Here, the green line is Australia. It is approximately around 4%. And United States, this is around 4% as well. Look at the Japan. Please look at this line here. Japan government yields always approximately during 10 years, 20 years, even 50 years, less than 1%. Why? Because their country has a huge saving. Okay, so just think this. You want to borrow from the market. You are government, okay? You are a government in your country and you want to borrow. You can borrow this money from your country, your household, right inside the country, or you can borrow from the international market. If you don't have enough money in your country, you will get that borrowing from international market. But if you have that enough saving deposit in your country, no need to go to the international market. So if you don't have those enough money and saving in your country, and if your risk is going up, if your inflation is going up, you will give higher return. And I'm asking just Dr. Walchin, just think that. Dr. Walchin trying to borrow, no, not trying to borrow. The government of Dr. Walchin comes to his office and say that your country needs you, okay, like in a war. And he is asking Dr. Walchin, you have $10 billion and we need your money, okay? And we will give you in return, as you see in United States, 4% fixed income return for your $10 billion. And Dr. Walchin asked himself this question. If I give this money to my government as a borrowing, right, as a loan, what will I get at the end? 4%. But this make me better or worse? The answer for this question is inflation. Because if Dr. Walchin gets 4% return, but if the 10% inflation in his country, Dr. Walchin lost 6% of real return in his money, right? Because he is getting nominal 4%, but his money melting across inflation 10%. So he is losing in real 6% money. So if the inflation is going up in a country, the government yields should go up. Government should persuade people to pay higher return and to not to suffer from inflation, right? So if the inflation is going up, your yield return should go up. So what is answer here? Why the Japanese 10-year treasury yield is just 1%? Because inflation is always less than 1% in Japan. They are not increasing their government yields because even they give 1%, their people getting positive return. But think the United States. United States offering 4%, but let's look at the United States. Look at this one. Okay. Now, this is like a finance session for us, but this type of multidisciplinary question is good for us. Okay. What we'll do? Generic government yield, right? Look at this. Here you are the generic government yield, right? This is my return, right? Nominal return from the government yield. Now, what I am doing? I want to see, because of inflation, first, if you are getting $100, and if the inflation in your country is 90%, your real return is just 10%, right? Because nominal return minus inflation is your real return. Okay, if you adjust with the price changes, you will find the real return in your budget. So I will make a spread. I will spread this from the CPI of the United States. And look at this. Do you see? And look at this. What you see on the screen, you are seeing this. Let me make this better, and not the daily, but let's say yearly. And let's make this histogram as in the style, not the line, but you will see. What is this? This is saying that if you put your money in 2010 to 10-year government treasury yield, you will get a real positive return. But if you put your money here, you will get a return from the treasury yield, but your money will be melted down because of the inflation. Your real return will be minus 6%. Did you understand what I mean? So while thinking about your money return, you should take into consideration the price changes, inflation. Okay, inflation always should be keep in mind to see the real effect on your money and on your budget. So why these graphs are related, did you understand now? Here on the left hand side, we have just the nominal yields of government return, but here we have inflation expectation. If I increase my inflation expectation, I will request from my government increase their nominal yields. Otherwise, I will not give my money to borrow them because my money will be melt because of the inflation, right? So if inflation expectation is increasing, the government yields increasing as well. You should keep this notation in mind that the inflation expectation and government treasury yields and those type of things move in the same schedule. Okay, this is important. Go down. And here we are. What we have here? We have here nominal yields. As you see here, Japan. It is around the zero. Why? As I say, there is no inflation in Japan. For that reason, even they offer to 1% of the government yields, everybody can give the borrowing to those governments because there will be no melt because of the inflation. But here as Germany or Australia, because of the higher inflation, they are offering higher yields for their citizen or for the international investors. Here the investment grade for Euro, US mortgage-backed securities, Australia as well. So what should you think first? You should keep in mind that we have risk asset and fixed income securities. And in fixed income securities, in risk asset, we have lots of risk. But in fixed income securities, we have main problem of inflation expectation and interest rate duration. If those is changing, I will make a loss, real loss, not the nominal loss. You can suppose that you are getting 10%, but your money in real return is melting. Okay. You should keep this in mind. And secondly, as you see here, we have government 10-year treasury yield, but not just the government giving the fixed income securities. Even the corporates like Amazon, like Tesla, like the Lufthansa can give the corporate bonds to the investors and offer them a fixed income and fixed return according to their investment decision. But here, what is happening? Do you see? Emerging market. And why the emerging market yields here and why the developed markets yields are here? Because of the risk. Okay. Because of the CDS, credit default swap. Look at the screen. Do you know this notation? Maybe some of them here or most of them here, but I should show this notation here about the where is it? Let's do it here. CDS, credit default swap. Okay. Look at the screen. Here we have CDX index monitor. Do you see this small screen? Yes, right on the left-hand side. This is CDS. For instance, if you look at the CDS in the emerging market or other countries, this is how your government can pay their debts or not can be pay their debts in a well manner. So if we have CDS, credit default swap, this is showing how risky your country is. And lots of investors adding those costs to your country. And because of emerging market are risky, their real return should be risky as well. So think this, just think this in your mind. Switzerland saying that I am giving 1% of return for your 1 year investment. And Indonesia is saying that I'm giving 12% of return. Switzerland saying 1%, Indonesia saying 12%. Why the money goes to Switzerland and not go to higher return in Indonesia? Because of the credit default swap. Because the bird at hand, one bird is at hand, better than 5 birds at the tree. Okay. In Indonesia, you can even not get your money at the end. But in Switzerland, you will get. Okay. There is no risk there. But in Turkey, in Iran, you can even be arrested because you put your money in investment. Okay. So this is risk. So to persuade the people to borrow to you, you should offer higher return. Okay. If there is lower risk, you can offer lower return to your money. And let me turn back my asset prices as well. Here spreads across the fixed income and subsectors. As you see, Euro, United States spreads are lower, but when you look at the USD Asia high yield, it is 1,600 basis point, right? This is around 1.6% higher because Asia is risky. But when you spread between Euro and United States dollar, it is so low, so close to each other. They are riskless. But if you make a spread between the emerging market and Asian market with the United States, your risk in fixed income will be higher. And here we are, real return. What I say to you, what does it mean, real return? Real return means nominal return minus inflation. Okay, here you see the definition. Nominal yield less core CPI inflation. So if you put your money here in 2005, here in 2010 to 10-year treasury yield, or even 2-year treasury yield, you will get a positive real return. Okay, positive real return. But after the 2017, even you put your money in 2-year treasury yield, these are riskless money. Okay, you are borrowing to United States government, but even in that case, even you get 2-year treasury yield or 10-year government bond, it is not important. Your real return is minus. You are losing money at the end because of the higher inflation, men and women. Okay, because of the higher inflation during last 5 years, we are losing money in real return. In nominal return, we suppose we are earning money, but this is not true. Our money melting because of the inflation. And look at here, United States 10-year treasury yield. As you see, here we have real yields. Real yields are the light blue. Okay, light blue means if it is minus, nominal return is less than inflation. Government giving you 4%, but inflation is 6% in your country. Government offering 7%, but inflation is 8%. You are always losing money. But as you see, the nominal yields here higher, despite these dark blue are showing the break-even. Break-even meaning that how your money can be compensated with the loss of inflation. Okay. And on the left-hand side, we have global investment grade credit. Option adjusted spreads. What does it mean? Sometimes people get leverage and option position in financial market. Let's say Dr. Walchin has $1 million and he wants to buy a Tesla stocks in the Nasdaq. Okay. So he can put his $1 million and get $1 million cost Tesla stock. But sometimes if Dr. Walchin knows the financial market good, his financial institution saying that, Dr. Walchin, you can get a position with your $1 million up to $10 million as an option. Okay. If you think that Tesla prices will go up, you can take a position like a gambling to make a choose, its price will go up. So if its price go up, Dr. Walchin get $2 million. But what happens if the prices go down? This is like a gambling. Okay, these are risky assets. As you see, Europe, Australia, and United States, global investment credit grade here around just 200 basis points. This means that there is no risk. 200 basis point mean 200 over 10,000. Too low, okay? Basis point mean 10,000, over 10,000. So it is too low. But if you look at global investment grade credit for the, not the United States, but Turkey, or let's say Russia, you will see this basis point around 5,000. Okay. And US investment grade credit return composition. This is the latest data and year to date annualized. And as you see, total return in 2023 is positive. But as you see in 2022, which is the loss of year, approximately you are losing 15% of money. Huge loss. Okay. And consumer sector delinquency, we are speaking about the financial market and fixed income. As you see here, 90 days and percentage of outstanding balances. Consumer sector delinquency. Okay, what is happening here? Student, credit card, auto, and mortgage. And debt balance. These are $1 trillion, man and woman. $1 trillion. $1 trillion is a huge money. And in United States, we have $12 trillion in mortgage. Just think this. The gross domestic product of Turkey is 800 billion. Or just think, Russia overall gross domestic product is 1.2 trillion. Meaning that 10 times higher money than the Russian economy is in mortgage market in United States. Okay, this is huge. So these are risky side, these are risky asset, and to manage those risks should necessitate really good financial literacy. An emerging market, as you see, when you look at the United States or Europe, you will see just 2%, 4%. But when we speak about the emerging market bond yield, they are higher. Why? First, they are risky. Second, they have higher inflation. Okay, if a bond yield is higher, you should keep in mind two things: risk and inflation. Okay, if their risk higher, their yield higher. If their inflation higher, their yield higher. And real yield in the emerging market. Look at the Turkey. Here, my country. Your government paying you 20%, 10%, but inflation is 50%. You are losing money. But for instance, Brazil, they are offering good return because their inflation is normal and they are getting positive return, real return. Always look at real return. Nominal return will mix your mind and you will be supposed you are earning money, but this is not true. And lastly, asset class yields. As you see, fixed income is the orange line, as you see. Okay, convertibles, Australian 10-year, United States 10-year, local currency 10-year, global high yield bond index, United States emerging market. These are fixed income. And alternatives are offering higher return here as well. But equities, as you see, is lower return. So what's happening here? To stop and to summarize the issue, we try to today cover the topics of fixed income and asset price. And asset price is stocks, mortgage, equities, index, government bond, treasury yields. But some of them are risky and some of them are riskless. Riskless are government bonds and treasury yield. They are paying fixed return to you, no risk. But in risky asset like stock exchange, like option market, okay, like future market, you can lose huge money. And interest rate decision, central bank decision directly affect the fixed income return and asset price in the financial market. My presentation is end up here. If you have question, it will be my honor to reply those questions as well.
Thank you very, very, very much, Dr. Abdulkadir Dogan. As usual, your presentation has proved truly awesome, outstanding. I love it. I'm not an expert in the field of economics, but since I'm part of the global world, the global family, so to speak, I too am very deeply interested in knowing as much as I can about the economy. That was very, very top-notch presentation about what we need to know when it comes to striking balance between what they call risk assets and fixed income securities. A very, very important topic. As I said again, whether we are in the world of business or not, we are concerned about what's going on in the world. So if you want to know more, our expert, Abdulkadir Dogan, is here. Thank you very, very much, Dogan. Thank you to each and every one of you as well, our participants. This would not have been a success as it is without you. Once again, on behalf of Atlantic International University, I'm saying thank you. Now it is your turn, ladies and gentlemen, to ask Dr. Abdulkadir Dogan to clarify some of the points that have proved unclear, or whatever you did not understand, or whatever you want to increase your knowledge about. Please raise your hand. You know how to do that by going to the horizontal menu at the bottom of your screen. We are ready for you. The first question from Festus Kongo Ali. Festus, go ahead. We are waiting for your question or comment. Your microphone is on, Festus.
You can write your questions as well. Okay, in the chat site, you can write your questions as well.
Okay, that's a good clarification. If for some reason your microphone is not working well, you may type in your question on the chat line. Either Dr. Dogan or myself, we will read the questions so that everybody can hear, and then we will come up with an answer. All right, let's try now Alice Tembo, the second participant who wants to ask a question. Go ahead, Alice.
All right, thank you very much, Doc, and very insightful presentation. From what I have heard this afternoon, it's afternoon in Zambia. Okay. One of the things that clearly government bonds, government securities, they are considered to be low risk or no risk at all. I think that's the term you use, that they're riskless. But then I'm just thinking about certain times that a government has actually gone in distress. We know the situation that happened with Greece at one point. So at a point like that, where the government of Greece literally was going bankrupt, if any of the investees had any investments in government bonds held by the Greek government, would those have been considered as risky? And I know this is one of the areas. I'm an auditor by profession, and I know that sometimes when we are doing valuations of for a number of securities held by our clients, and you want to impair government bonds, the response we get from central banks is that the government can never default. What are your views on that? Because I know that it's something that between auditors and the regulators, we are always fighting each other.
Okay, Thanks for your question. I can, because we have limited time, I want to answer other people's question as well, but to give a clear answer for those type of question, any firm can go to bankruptcy, but no government go to bankruptcy, okay? Because if you are there, that money will be paid at the end, in any case, even in inflation, even in bad problem, even in moratorium, even in those side. Let's think Greek side. Greek government go to like a bankruptcy, the government crisis, and all the European Union support and give the loans and all the money paid. Okay, there is no case like a government saying that I'm not paying that money. You will pay this money at the end. For that reason, you are government. I'm not buying a corporate bonds. For instance, you can take a corporate bonds from the market, but that company can be close their door, stop their production, and go to bankruptcy. And they can say that I will not pay because I go to bankruptcy. But governments are not firms. They will pay everything.
Thank you.
Thank you very much, Dr. Dogan. Before we go to the next hand, there is a crucial question on the chat line that is from Dr. Haile Tariki. The question is as follows. How do we control inflation like it's happening in Japan? And what do you think are the major causes for inflation, Doctor?
Okay, this is a good question. If you understand this question, no need to go back to the presentation. If you understand the inflation phenomena, you will understand most of topics in the economics. If you understand, as I said, if you understand my answer for this question, this can be the last question here as well, because it will reply everything. Inflation is always and everywhere a monetary phenomenon. This is the Milton Friedman say, okay, monetary economist, inflation is always and everywhere a monetary phenomenon. If you have excess liquidity in the market, this will create inflation. But sometimes inflation not just be created by demand, it can be supply side inflation as well, okay? Supply side inflation. For instance, if in this room, everybody can try to get car in Zambia, the prices of car will be increased because everybody demanding, right? If we increase their demand, the car sale people saying that the price is increasing because everybody wants to buy. But if nobody wants to buy, they will decrease their prices, right? Otherwise, they will not sell anything. So demand side can be controlled with monetary policy, okay? With monetary policy, interest rate decisions, macroprudential policies, interest rate decision. By supply side shocks are a little bit worse, like the COVID crisis, like the Russian-Ukraine war. Even you are not giving the money to the people, but because there is no enough supply in the market, the prices is going up. Okay, there is no supply. Nobody giving the natural gas to the market. Okay, even you don't buy, the price is going up because there is a supply crisis in the market. Demand crisis, demand-driven inflation can be managed easily, but supply-driven inflation is a little bit hard to deal with. So here you should increase your productivity, you should increase your infrastructure. For instance, if you have a good infrastructure, let's say Europe, they are dependent to oil and oil products to the Russia. If they have the infrastructure to get all oil from Iran, is the oil prices increased? No, but they have only infrastructure to get those oils from the Russia. When the Russia cut, the price is going up and inflation. So productivity, infrastructure, technology, all these type of things are really important, not sufficient, but important to manage the inflation phenomena. So inflation has two reasons, demand driven and supply side. Demand driven inflation, because we are creating demand, their price is going up, but this can be managed easily if you increase the cost of money, interest rate. The demand will be go down gradually, like in the United States, they are increasing the interest rate and inflation start to decrease. But if you have supply side crisis in inflation, it is a little bit hard to deal with. Okay.
Wow, that is impressive, Dr. Dogan. Three very key topics or concepts in that response: supply, demand, interest rate. If you can combine those three, like Dr. Dogan has pointed out earlier, you have the entire presentation in your hand. Dr. Dogan, remember our first question was coming from Festus Kongwe Ali. For some reason, he had an issue with his microphone, but the question is here on the chat line, and I would like to read it so that our first questioner, if we may call him like that, can be
Dr.
satisfied.
Watson, let's say this will be last question. Okay.
I'm so sorry. Let me read that quickly from Festus. I would like to know if it is possible for a middle income household head earning less than $50,000 annually in Africa can participate in the financial market. Last question, last answer, Dr. Dogan.
Could you repeat, because your voice is going up?
Oh, I'm so sorry. What's going on in here? The question is, I'm reading verbatim word by word. I would like to know if it is possible for a middle income household head earning less than $50,000 annually in Africa can participate in the financial market.
Everybody can participate in financial market, even they can earn $1. Okay.
Okay.
There is no restriction to take a position in financial market. You can get financial market means stocks, a fixed commodity. You can get 1 barrel of commodity in option market, Brent oil, with $140. You can take one Tesla stock and take a position with $200. Even you can get a huge $1 million fixed income securities or stocks in the financial market. There is no up or down limit for the financial market entrance. Okay.
Thank you very much, Dr. Dogan. As you can realize, ladies and gentlemen, we have lost the video feed from Dr. Dogan, probably due to network issues in his area, and that's the reason why the communication was not going to him very easily. But unfortunately, that was the last question. That's the last answer as well. I know there are some other questions on the chat line. I can see some other hands, but two things that I would like to mention to you, ladies and gentlemen. Number one, we are indeed out of time, and Dr. Dogan has indicated that was the last question he was ready to answer. And number two, I see that question on the chat line, and some students ask, some participants instead, not everybody is a student. Some participants have asked that question as well about how they can get the presentation, whatever day, whatever live session, and so forth and so on. I keep saying that the link to the entire presentation is usually sent to every participant. There is no need, for example, to put your email address on the chat line, since it is sent automatically to everybody who has attended the session. The system does it automatically. Another option is you go to your student portal. For those of you who are students, you can also see that link to the presentation. The third thing is, as I speak right now, the session is being broadcast on Facebook. And anytime you go to Facebook, you scroll down after you type in Atlantic International University, you will see all those presentations, all previous live sessions. They are there on Facebook. You can just play at your leisure and, go forward, go back, and so forth and so on. That was it, ladies and gentlemen. I am very, very thankful to each and every one of you. I'm saying this on behalf of Atlantic International University that has made this possible. And this was a success as well, as I said earlier, because you attended the session. Thank you to each and every one of you. And if you want to just shout thank you to our presenter, Dr. Abdulkadir Dogan, this is the time. Thank you very much, ladies and gentlemen. And I pray
Thank you.
all
Thank you.
best.
Bye.
See you.
Have a
Thank you
nice
very much. See you
Thank you,
next.
committee. Thank you.
Thank you and goodbye.
Thank you very much.
Thank
And
you
goodbye.
from
Thank you.
Kenya.
Bye-bye.
Bye.
Thank you.
Bye.
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 From Niger.
Bye. Bye.